this video, we're going to have a look at Agree Realty Corporation, ticker symbol ADC. ADC acquires and develops properties leasing to retailers across 49 states. The company has a portfolio of 2004 properties containing approximately 42 million square feet of gross leasable space. As interest rates have risen, REITs valuations continue to suffer. ADC's stock price has continually dropped since February this year. It had a 52-week high of $76.40 and a recent low of $60.79. It hasn't been this low since the pandemic drop at the beginning of 2020, then prior to this, the beginning of 2019. When we zoom out for the bigger picture, we can see that overall it has been a sound investment. The yield is currently 4.75%. Let's have a look at the dividend history. Looking at historical data, dividends have been paid quarterly since June 1994. Starting at 35 cents, year-on-year increases. If we scroll all the way up to 2010 at 51 cents, they then cut it down to 40 cents. Given the financial crisis, I'm surprised they didn't cut the dividend earlier. A cut would have made sense. So starting at 40 cents in 2011 and scrolling up, rising each year all the way up to 62 cents. Then in 2021 they changed monthly, that's why it's dropped, but it still works out the same, and then continually raising up to where we are today, just over 24 cents. Seeing this is very reassuring, having almost 30 years of continued dividends. Let's have a quick look and see how it's performed against the S&P. If you'd invested $10,000 10 years ago and reinvested the dividends, you would have a total return of 254.74%, ending with a value investment of $35,465.65, beating the S&P. As always, the S&P still gives you a decent return, but ADC has performed really well against it. If we go back even further, 20 years, it's been even better, a total return of 704.36%, giving you a whopping $80,378.95, outperforming the S&P by 177%, almost $18,000 more. Out of all the comparisons in previous videos, this is second only to Waste Management in terms of beating the S&P. Another great stock for those who invested. If we look at the financials, ADC market cap is currently $5.93 billion. If we have a look at all the metrics, everything is looking great. Year-on-year revenue has a perfect upward trajectory, making a jump of $100 million from 2021's revenue. EBITDA, great as well. The all-important free cash flow is exactly what we want to see. This ensures that dividends can be paid. The payout ratio is 163.13%, which would be a red flag if it wasn't a REIT. For REITs, it's better to use the adjusted funds from operations metric, abbreviated as AFFO. Seeking Alpha has worked that out, which sees a payout ratio at 73.80%, which for a REIT is good and more than covered. Let's see what the analysts are forecasting. CNN Business have an average 12-month price target of $75, which is 22.1% upside. That's based on 12 analysts. TipRanks have an average price target of $74.36, which is 21.11% upside from where we are today based on 8. And Zacks have an average buy price of $74.71, which is 20.85% upside from where we are today based on 12. The price targets are almost exactly the same across CNN Business, TipRanks and Zacks. As an average price for the three, that is $74.69. If we have a look at the intrinsic value calculations based on the discounted cash flow, it's coming out at $65.51, which is 6.69% upside. Then if we look at the dividend discount model, it has a fair price of $46.49, which is 24.5% downside. If we take the average of the analyst's expectations and the investing models, that would give us $62.23. With a 10% margin of safety, that would be $56, which is lower than its recent low. Given how volatile the market is at the moment for REITs, it could easily drop to that. Once the market stabilises and the rates lower, REITs will recover and ADC will be fine. Having a look at how ADC has performed against the other competitors, for ADC we can see that bar this year and 2020 COVID, it has given solid returns, having mostly green years, more than any other REIT. Then if we look at the compound annual growth rate, the last 3 years have been terrible. COVID played a huge part in that, plus the recent interest rate hikes. Over a long period, ADC has performed well, though, and as a long-term investor, this should be taken into consideration. So this can be seen as a good buying opportunity at those levels. As usual, thanks for watching. If you've enjoyed the video, please like and subscribe.